Okay, so what type of funding is right for you? Well, let's first talk about some main types of funding available. For startups, we have bootstrapping, friends and family, angels, family offices, venture capital, which is what I am, accelerators, incubators, crowdfunding, crowd equity, bank loans, venture debt, other types of debt, government spending, SBA, for example, grants, and those are just a few. Now, look at this list and see how many of these terms you understood before today. I'm going to make sure that you understand at least a little bit about each one of these so you can start to make the right decision about which one or more are right for you. Friends and family. Now, a lot of you may have heard of friends and family rounds in startups, especially in startups. If you're like me, a few years ago, you would not have had friends or family who could have made an investment in your company. But what a friends and family round, you'll hear that term, is when someone in your immediate family or immediate network of friends has capital that they can spend. Let's say they make $100,000 a year, they make $200,000 a year in some profession. They are great savers, and they also like to diversify their portfolio of investment. And they think that startups are interesting and fun, which a lot of people do, especially these days. And they want to put their money behind you. So you might say, I have this company and I need $10,000 to get it going. So I'm going to do a friends and family round where I ask 10 of my friends and family to put $1,000 each in, or I ask 5 to put 2,000, etc. It may be anything from 10,000 to 100,000. I've heard certain people get in the six figures when they do this friends and family round. But really, there's not a real structure around it. There's no exact amount that people raise in that amount. But you'll hear this from different groups. Now, it's not for everyone because not everybody has friends and family who can put together money. Another reason is, even if you do, let's say you do have friends and family who are willing and able and excited to put money behind you, please be very, very careful in these early stages of your company. When you see that check, not to get too excited, to be very sober in your thinking, because those friends and family are the people that you want to do the best, right? You want to look out for them just like they want to look out for you. So please be very sure and very serious about your company and understand that they are doing the equivalent of putting down money for a lottery ticket. Let them know that they are more than likely statistically to lose every bit of their money on your investment. It's not because you're not a good person or a good steward of capital. It's because more than 50% of all startups fail in the first 2 years. It's just the way it's gone. So they have the same, I don't know the exact odds, but their odds are against them in making their money back, let alone making 10x or 100x what they may be thinking about. So it's very important that you, as the leader, as the CEO of your company, are very straightforward with them, even if they are easy money, seemingly, because you don't want it to get awkward in those low times. You want to be almost overly cautious with them. You want to let them know all of the pitfalls and say, if you still want to join me after you've heard all of the pitfalls and things that could go wrong, I will gladly take the 2,000, the 5,000, the 20,000 that you are able to give me to let me start and kickstart things. Another thing is, try not to take too much of one person's capital. What I mean by that is, you may have someone who has saved, let's say they've saved $50,000 over the past 10 years because they're great savers, and they know that you need $50,000 or you want $50,000. if I were you, and I don't know your circumstances, but if I were you, I would not allow them, even if they wanted to hand you over their life savings. Because again, it's so risky. Startups and starting companies in general are just a very risky asset class. And so what you want to do to them, what you say to them is diversify your portfolio. I'll take 5,000 of that. And the other 45,000, please consult your CPA, your legal team, and ask them how to invest that money. That makes you a responsible leader. And believe me, you will be very happy that you did that a year from now, 3 years from now, when they come back wondering how your company is doing. You no doubt have heard of angel investors at this point. If you haven't, that's okay. Now, your friends and family that we talked about in the last video could be also angel investors. They're kind of interchangeable. The difference here is an angel investor in your company is more than likely someone that you don't already have a friends and family relationship with. You may have a professional relationship with them, like they may be your former boss, for instance. Or you could have just met them for the first time at an event, or a demo day, or some sort of online connection. Someone may have introduced you to an angel investor. Angel investors, like friends and family who would invest in you on the friends and family realm, are those who have a certain amount of capital that they want to put out into the world. Now, some angel investors are very structured and professional, and you don't have to be. There's really no regulation around it, except that you must be an accredited investor, meaning in the United States that you make $200,000 at the time of this filming alone, or $300,000 plus with your spouse. And so that is just the government's way of making sure that people don't overspend on startups and entrepreneurship. Whether you agree with that or not is another story. We'll talk about crowd equity funding for those who don't fall into that category later. So an angel investor, you may have met them at an event, or they may have been introduced to you. The important thing is understanding their agenda, their values, their thesis, and really the dynamic of the two. Again, just like with friends and family, angel investors can come along and be it can be a very tempting offer, because you could be in a situation where you feel like you need $10,000, $100,000, $50,000, $5,000, and someone comes along who doesn't really owe you anything or know you that well and says, I believe in you, and so I want to write you a check. Now, the problem with that sometimes is that a lot of angel investors, since they're so early, they can be in a leveraged position where, for instance, let's say you need $20,000 to get your company going, in your opinion. Imagine someone comes along and they say, I have $20,000 for you, but I want 40% of your company in order to do that. That is a lot of equity. That hurts my heart to even say out loud, but I've heard it so many times. And the person who is on the other end of that, who needs the 20,000 and hasn't seen 20,000 in their bank account before or all at once, really feels like, okay, if I can make this company more valuable, it'll be worth it, and I'll have the majority of it. The problem with that is that as you go along on your journey, you may have to raise again. And every single time you raise money, you dilute your cap table. We'll talk about terms and jargon in another video, but essentially it means you're giving away more and more and more of your company. I think of it as a pound of flesh every time I give away some piece of my company. So I really imagine that, because it makes it easier for me to say no to people. So angel investors are really, for the most part, wonderful people. There are certainly some people who are predators, but most of them are really earnest, sincere, honest people who want to give you capital, their insights, their experience. And some of them, what you'll find is they've been working in a certain industry for 10 years, 20, 30, 40 years. And they find themselves with extra capital. They're doing okay at home. And they're kind of missing out on that juice, that early fuel to the fire. And by writing you a check for 10K, they get to be in the game again. So again, weigh both of those things. Do you want someone who can write you the check, but maybe calls you every day of the week? One way you can get around this and not even worry about this is by having very structured terms when you go in. And I'm not just talking about the terms of your agreement legally, because you certainly should have legal help along the way. But I'm talking about maybe an email, a piece of paper handwritten, one of the two, where the two of you, you and your angel investor or several angel investors, get together and say, this is what I'm expecting, and this is what the other person is expecting. And I agree with that. And maybe there's something on that list you don't agree with, and you can talk about it. And as you go through that process, you'll learn about, is this the right place for me? Are these the right people for me? Is this the right fit? Founder, investor fit. It's important that angels exist. I am an angel myself. I'm a venture capitalist, and we'll talk about the difference later, but I'm an angel as well. So I make direct small investments into companies when I have the capital to do so. That's from my personal bank account. And what I try to do as an angel is be hands off, but be available. I want to be there in that important call if you need something. Do you need an intro to a major client if you're a B2B company, a business-to-business company? Do you need me to reach out to another investor that might like what you're doing? There's a lot of relationship stuff we'll talk about with investors later on in the course, and we'll come back to this topic over and over again because angel investors ultimately are your friends, and angel investors are a wonderful part of the ecosystem. We won't spend too much time on family offices in this course, but you may hear me talk about them later on, especially when I talk about venture capital and how it works. Family offices are what they may sound like. It is when a family or a group of families who are very wealthy decide to put in structure their wealth management and their investing. So they would structure around their investment a thesis, a plan, and execution. They may even bring someone from the outside who is not part of their family to manage this like a major fund. It really all depends on the individual family, what they want out of it, and how much money they have to invest in different asset classes. What you'll find is that there'll be several family offices all around the country and all around the world, but you don't hear too much about them. And yes, you may be thinking, does my favorite celebrity or my favorite sports star, I don't know sports lingo, or this other rich person I know, do they have a family office? More than likely they do, but they don't talk about it in public because they're doing things behind the scenes. Someone that comes to mind is Will Smith and Jada Pinkett. They have a family office. They do have a website for it. You can search for that. But they don't talk about it too often in public. We just know that they're making moves behind the scenes because they're diversifying their portfolio. They put things in structure. They're not only working on entertainment. They're making investments into startup companies, into growth companies, which are companies that are way past the startup phase. They have money in stocks and bonds and all that, and they're just looking for the long term. They definitely have been people that I look up to as people who look long term when it comes to their wealth. They didn't just make the money from being on TV and film and say that'll be enough for us. They said, how do we take this seed money and 10x that, 100x that? So they're an example of what a family office looks like. Most family offices are really, really boring, to be honest with you. They're just a structure. They're a group of funds or LLCs and this and that, and they're run very like a tight ship. And you usually have to have very warm introductions to these companies. It takes years and years of branding, reputation building, which we'll talk about later in this course, to even get in the front door of a family office. The thing about family offices, though, just a side note, is that they can make decisions pretty quickly just like angel investors, but they're writing checks usually that are the size of funds. So that's an interesting dynamic. And usually family offices will make direct investments in certain companies, and then they'll make investments in other funds. So we have investors in our fund, Backstage Capital, that are family offices. Now, again, they're elusive. They're not super important when it comes to talking about the kind of funding we're talking about, but I wanted to make sure that you knew what they were so that you could understand when I brought them up later in the course. Let's talk about venture capital. Honestly, could do an entire course about venture capital. It is what I've spent the last 8 to 9 years of my life studying, working on, executing, and it is just one tiny module in this whole course. So for our purposes, I'm going to give you a very, very high overview, and we'll drill down another time on venture capital. I'm a venture capitalist. The best way to think about it is the difference between a venture capitalist and an angel investor, for instance, that we learned about earlier, is that a venture capitalist is spending the money of other high wealth, high net worth individuals. Some of that money is of the venture capitalists themselves because of the structure, usually between 1 and 20%, more so on the 1 to 2% side of things, usually. But it's large sums of money in most cases. We're talking at least in the millions, sometimes over $1 billion, that a venture capital fund manages for other people. Again, this could be an entire course on its own, so I'm going to be very high level here. One thing to understand about venture capital is once you start, you kind of have to go in this sort of order that's structured. Venture capital has been around for more than 70 years. It's centered in Silicon Valley, New York, Boston, but now it's all over the country. You have these stages of funding called series. Starts with pre-seed, series seed, then there can be like a series seed extension, then there's a series A, B, C, and so on. I've seen them go up to H, something to that effect, not much further than that, but usually they're between pre-seed and series D before you see them go off and either unfortunately fail or go public, have an IPO, which you've seen where they're ringing the bell on one of the stock exchanges, or get purchased or acquired by a bigger company. You may have heard that a company was acquired, for instance, by a Microsoft or a Google or a Facebook. That's the type of thing I'm talking about. So some of the companies who have had venture capital are Facebook, Twitter, Apple, Airbnb. Many companies have had venture capital, but not all companies have had it. And I think that's where a little bit of the myth comes into play, because I think a lot of people, especially in the early stages, and if you are in this course, you may be in the early stages, think, I need a venture capitalist. I need to be around venture capital. It's not the case. You may have other options before you, and I'll talk more about those later. So venture capital is, let's look at the pros, cons, and whatever. Lots of equity dilution. And the terms and jargon, we'll learn about what those things mean. But again, it just means you're going to take in money, but you're also going to sacrifice ownership and equity of your company. And this is going to happen multiple times, usually in the venture capital process. You're going to have an investment series seed. You may have 12 months later a series A, maybe 18 to 24 months after that, a series B, and every single time your equity is getting smaller and smaller and smaller. Check out an episode of Your First Million, my podcast, where I interview Delane, who owns the esports company. And he talks about how even though he's raised more than $100 million to date, which is nuts, he still thinks about that equity that he doesn't own anymore. So he has more money to do the things he wants to do and build the company he wants to build, but he owns less of it. So there is a sacrifice. Check out that episode to learn more. Again, there's a lot of money flowing back. There are $130 billion in venture capital flowed in 2019. Incredible. But here's something that you may not know. Did you know that if you take on venture capital money, I guess venture capital money is redundant, but if you take on venture capital, did you know you could be fired as the CEO? I've seen it happen multiple times. Because they have so much ownership in your company, you do not make that decision after a while. You have to take on a board in most cases. You have to have other people in your sauce in your business. And if they don't think you're doing a great job, especially later in the process, they can fire you. There are high expectations when you take on venture capital. Lots of high expectations. They traditionally want you, and we traditionally want you, to 10x or more their investment. That means make 10 times or more the investment they put in you. So imagine you take an investment today, 2020. You take an investment, take $1 million in, celebrate, here's woohoo. But they want to make at least 10 million, which means if they gave you $1 million for 10% of your company, for instance, they want your company to be worth $100 million one day, and they want to take 10 million of that. And to get there, you probably would have to do more rounds. So you'd have less and less and less funding. It's just really important to think about. Now, the upside to venture capital is that I just told you, Facebook, Twitter, Apple, all of these companies had venture capital money. The right companies, and particular companies who do need that growth capital, that inflection point, can do really well with venture capital. They can have major outcomes. We'll talk a lot more about the difference, the wins and the whys, what you should take, all of that in the next module. Okay, we're going to touch on crowdfunding versus crowd equity funding. Crowdfunding is what you probably are used to from Kickstarter, Indiegogo, and maybe even Seed and Spark, which is a company that I invested in. Crowdfunding is when you put $20, $50, $100 into some sort of project, usually a project, and you're doing so with a lot of other people who are strangers so that that project can get made and be a reality. Usually in exchange, you get a t-shirt or a shout out online or the finished product. Crowd equity funding is similar, but instead of getting the t-shirt or the shout out, maybe in addition to or instead of, you get ownership, true ownership in that company. So let's say there is a company that is raising $100,000. They have been doing their thing. They have some revenue. They have some traction. They've been around for a year. And now they want to give the crowd, their audience, and other strangers the ability to have ownership. They may say, okay, for 25,000 of that 100,000 that we're raising, we're going to give the crowd the ability to put as little as $100 a piece themselves so they can have a piece of that. Now, that's really interesting, and part of the Jobs Act made it possible for people to invest that small amount of money and up. So usually crowd equity, or in the past, crowd equity has only been reserved for people who are accredited. If you paid attention to the friends and family and angel rounds, you know that accredited means you make at least $200,000 a year by yourself or $300,000 plus with your spouse. And it's just a way of the government understanding your ability to make investments soundly. So it used to be that only accredited investors could do that. But now with the Jobs Act and a lot of work, years and years and years of work by many, many people, now you can invest $100, $250, $1,000 into these companies that do so online. Companies like WeFunder and Seed Invest and Republic.co, iFund Women, etc., make it possible for you to go. You can search around your favorite type of thesis or your favorite type of topic, and find a company that you can throw in 250, etc., and become an owner in a company. And I just think it's really awesome. And I love that option. I've done that many times. For you, this could be a way that you raise capital while testing the market. So if you have a company that you have some traction with, I recommend you having traction with it before going out, because you do have to fill out a lot of paperwork. You have to show your financials publicly, and you have to give them a really, really good reason to spend money on you. But you might find yourself needing some sort of bridge capital, and this is a really interesting way that you could go about finding that capital while also doing some market research. I've seen a lot of success here. I really like I mentioned before, like WeFunder, Republic.co, iFundWomen. These are all types of companies, but you can look them up. Go ahead and look up crowd equity funding, and there's dozens, if not hundreds, of these platforms, and you can look up reviews and see what might be best for you. The important things to take away here are that they're not for everyone, just like most funding, and that you do have to reveal and divulge a lot of information that sometimes you don't think you do when you just look at the websites. So definitely get in touch with them one-on-one, ask them what they need, what you need to reveal, and make a decision that is right for you. Is that something I want to open myself up to? If it's not today, it may be a year from now or another time that is better suited. I've also seen a really interesting idea and a way this has been executed by a company called Gimlet, which is a podcasting company. And what they did was they raised venture capital and angel money in the millions, and they let the last $250K be for their audience because they wanted their audience to have a piece of the pie. So when they did well, which they did by being acquired by Spotify a few years later, their audience did well. Anyone who signed up in those first few days. So it's a really interesting way of looking at it. It's a really great case study. If you have the time, check it out, look it up. So very briefly going to talk about debt and grants. Debt can come in forms that we all probably are familiar with. I've been in debt most of my life. But debt here is when you take out a bank loan, which it has its own problems, or when you take out an SBA loan, which a lot of us have learned more than we ever thought we'd know about in the last few days because of coronavirus. But that's an option, the government. And then there's venture debt, which is more so part of venture capital, which is in the form of notes and convertible notes and safes and all sorts of things there. I don't think we're going to be able to really get in the weeds when it comes to venture debt. But I will say that it's a way that a lot of companies at the beginning structure. So we'll talk about a lot more later on. When you've heard of these things called convertible notes or a note or a safe, that's usually what they're talking about is venture debt, which is an investor giving you capital, but they're not taking equity right away. They're giving you what is essentially a loan that they hope converts to equity when you have another round of funding that values your company. The reason you want to do this early on sometimes is because sometimes really early, it's hard to value your company. It's hard to say what your company is worth when you haven't made any revenue, for instance. So everyone agrees on the cap table, okay, we'll do this as a loan. Hopefully in the next 2 years, you'll have some sort of event that lets you price this round, give me my equity, and then we're all good and we'll keep going in that process. And that's just another way of looking at it. Grants, other resources, there are all types of grants. We're not going to get into all of that here because I'm not an expert in these. And so I don't want to give you any information that I'm not really clear about, but just know that there are a lot of grants. There are a lot of nonprofits, philanthropic things, Kauffman grants, for instance. And then there are a lot of grants that are more for research that are done from colleges, universities, and usually, depending on what type of company you have, investors later on don't really mind if you have grants early in the process. So like, for instance, let's say you go out and follow up on a grant proposal that someone has, that they have an application process for $10,000, you're usually not going to have an investor later on upset about that. All right, we have reached the video where I get to talk about my favorite of these types of funding. What do you think my favorite is? Well, actually, I think the title of it lets you know. So I'm going to reveal it anyway. Bootstrapping. Bootstrapping is my favorite type of funding. Bootstrapping with revenue, but there are many ways you can bootstrap your company. Let me tell you why bootstrapping is my favorite. And I hope that if you take nothing else from this entire course, that you take this in. Here are some benefits of bootstrapping for as long as you can do so. Let me just tell you really quickly what bootstrapping is. Bootstrapping is when you don't take outside funding and you rely on things like revenue, savings, etc. to fund your company for as long as you possibly can. Now, in the past, I've bootstrapped many things, not successfully though, but I have to tell you, it is still my favorite after having it all different ways. After trying it very leanly and of trying it with lots of capital, bootstrapping is still my favorite. Let's talk about some of the pros. You're in control. Earlier, we talked about a few types of funding, especially venture capital, where you don't have as much control of your company as you probably would like. Bootstrapping, even though it's uncomfortable, and let me stress, it is uncomfortable, it allows you to stay in the driver's seat. You have creative freedom, which is so important to so many of us. A lot of us are alphas or have some sort of leadership skills, and we want to be able to express ourselves in a very particular way. And people may not always understand why we're doing what we're doing at that time. When you bring in outside investors into the mix, you're going to have their opinions everywhere. It gives you room to make mistakes. It gives you room to fail. Other types of funding do the same. So friends and family may forgive you for failing. It's okay. But some of them might not. Some of them may give you some sort of grief for it. But venture does not allow for much failure because they are looking to make at least a 10x return on their investment. They can be your friend, but they're also your co-owners and eventually your boss. Your venture capitalist is eventually your boss. So when you make mistakes, when you don't do things the way that you wish you had, if you have been bootstrapping the whole time, and that means you right now, like you may feel like, oh, I'm not a success because I don't have any outside funding. You're bootstrapping your dream. And right now, even though it's uncomfortable, maybe even painful, you have room to fail because you are your boss. The definition of success changes. So again, you may not want to 10x your company. You may think that having a 6-figure income every year, being able to pay your bills, being able to pay an employee or two, is the best life. You get to live your best life. You get to do what you want to do, especially in these times. That's not really going to move the needle for an outside investor, but it can be life-changing for you. So you get to have control of what your definition of success is. Therefore, it gives you more time. Because you're under the constraints of returns on investment and other types of funding that has to do with investment, this way allows you to stretch out the amount of time you get to work on this particular project and to decide if it's for you. You're not under that microscope and under that pressure. Your lifestyle can be different because of that. You have fewer people to answer to, like I said before. You can focus on your customers. Think about it. If you have more time because you're not on the phone with investors, you're not making investor reports, you're not answering to people, You can answer to the people that matter most at your company, which are your customers. You can see what they like. You can see what they're asking for. You can handle any type of issues, customer service, and providing a wonderful shopping experience for your customer, which is really what it should be about. The outside investor can not play a part, which gives you more time to focus on your customer. It helps you determine if the company is the right fit for you. Like I said before, it gives you time to fail, to try, to experiment. And you might come to the conclusion after a few months, a couple of years, or even a few days that it's not for you. But because you didn't go out looking for outside capital so quickly, it gives you more time to find out, hey, I can pivot. I can do this other thing I wanted to do. I can do multiple things. Now think about it this way. Let's say you want to bootstrap today, and then in the future, you want to go out looking for funding. Imagine your company right now could raise $100,000 in exchange for 20% equity. So your company is valued at $500,000. If you bootstrapped, there is the potential that you could raise the value in your company simply by having a better product and a better and more traction, more sales, more customers, more revenue. So that 2 years from now, when things are really hopping and you really want to go for the gusto and really go for the stars, your company is now valued maybe at 10 times that amount or more because you bootstrapped uncomfortably for a specific amount of time under your control where you were able to learn, experiment, fail, try again. This puts you in a very powerful position, even if it doesn't feel like that when you're struggling to pay the bills. I have had no money. I have lived in airports, on couches, in cars. I have had lots of money. The difference is, there's a difference, I'm not going to lie. But I would rather, and I mean this with every fiber of my being, and I hope you hear me, I'd rather be broke with control than rich with lords over me, with people, with men and women who tell me what to do. And the more powerful a position you can get yourself in, it's always going to be the better deal long term. Here's a case study to give you an idea of what I'm talking about. Tim and Kim started Curl Mix a few years ago. I met them in the spring of 2017. When I met them, they were making about $10,000 a month in revenue mixing hair products in their kitchen, which was amazing to me. I thought that was really awesome. But in venture terms, it's not a lot of money. I became an advisor and backstage took equity in Curl Mix for the advising. Later, we invested $25,000 and gained more equity. They turned down 6 figures on Shark Tank because they felt that the valuation was much too low for their value. Now the sharks thought, hey, we're giving you all this money. How could you turn this down? You all are just making hair products in your kitchen. What are you doing? But they knew their value and they knew what they were willing to sacrifice in bootstrapping to reach that value. So they took very little angel money. So there's a little bit of a combination, a little bit of angel money, a little bit of demo day, a little bit of bootstrapping, a whole lot of bootstrapping actually. In April 2019, they had their first $1 million month. 2 years after I met them. Incredible. They have generated nearly $6 million since they started. It's incredible. Today they have, this is the best part. This is the whole point of this. Today they have majority ownership in their company, which is one of the fastest growing hair care products in the country because of the decisions they made early on. And when I tell you things were tight for them, they were. They had kids. They had responsibilities. They're a married couple. They would have really probably enjoyed getting $1 million in venture funding early on, but their cap table and their equity split would be very different today if they had done that. And I think that constraint of capital is what made them what they are today. Check out the next video to see them talking about that success. Now, here's some ways to bootstrap. Now, here are just a few ways you can bootstrap. And we're going to talk about, in a different module, all types of revenue streams that I have and that I've seen other people have that get you in a position where you can spend that money on your company and have the control I'm talking about. So let's go through the list. I call it creating, customizing, consulting. You do what you gotta do within reason and legally to make money and save money so that you can do the things you want to do at your company. Do as much as you can yourself before hiring or spending. Simple. So many companies, founders come up to me and they're like, I need $100,000 so I can hire this marketing guru. No, you don't. You can spend a weekend, take a couple of courses, learn yourself, break out the thumbs, and do it yourself. Do as much as you possibly can by yourself. I don't know how to code, but there are so many websites and apps and companies that are without code. You can set up shop without coding. You don't need to spend $50,000 building your website when there are companies out there that exist just to do that for you. Just for you to sign up $29 a month, $100 a month to have it all laid out for you. No code. Do the research. Take away some of that expense and you reframe things. Cut down on your expenses. Cut down on your expenses. Make a list of your monthly expenses right now and say, what of this can I change? If you are out there trying to raise $250,000 because you think that'll last you 12 months, I guarantee you, if you go through this list and you slash this product and you change that and you get rid of this and you only do half of this and that there, I promise you, you won't need what you thought you needed to get where you're going. And again, when you lower your expenses and you have less to raise, you put the power back in your hands. You repurpose what success is. It gives you more time. I think we talked about this already. It gives you more time to make decisions. And when you have more time to make decisions, you make better decisions. Generate revenue sooner than later with company products or services. Seems simple, but sometimes people think that they need to wait for a certain thing. They need to wait for an investor to tell them it's okay to do something. Start doing the thing. Whatever your company is, whatever you do that thing and generate revenue. Invest in your company with the revenue that you make. I know it sounds simple, but some people get stuck there. And I really want to point out that that is your prerogative to do. Experiment with pricing and packaging to improve profit margins. Brand and scale your talents and your skills. You can do this by consulting for others. What I mean by that is, like, again, we'll talk about it in the revenue stream section. But right now, think about what your company is. Whatever your company is that you're trying to get off the ground. Have you thought about, some of you have, of course, but have you thought about consulting other companies or other people or individuals on the thing that your company does? So maybe your company has a $50 product or service that has a mass appeal, or $20, $6, or $300. Can you do a $2,000, $5,000, $10,000 price point for one-on-one consulting for someone else to make their lives easier? Can you do that? Can you create that? Can you figure that out over a weekend or in a brainstorming session? It will really depend on what your company is or what your product is or what your service is. But I bet you if you think about it hard enough, you will think of something. We'll talk about income streams later. Here's one. Keep your day job. How many people tell you to do that? How many investors tell you to keep your day job? How many people who are trying to sell you something tell you to keep your day job? I'm going to tell you, keep your day job. If you can, if it's not like ripping your soul and your heart out to do. This is a part of bootstrapping. This is a part of you being in control. Yes, you have less time to do the thing you want to do, but you have more control. People say that time is the most important thing we have. It is, but I happen to think that control over your destiny and over your life is equally important, if not more. I'd much rather have a high quality of life than not. And chasing investment capital or other forms of funding so that you can stop doing your day job, which already pays you, which already gives you insurance, which keeps you going, is not necessarily the best decision. Now, we have a whole module about doing all of this in the age of coronavirus and COVID-19. Many of us lost our jobs in the last several weeks. So when you're coming from that lens where you no longer have the day job, it's a different conversation. But if you still have the day job and you're figuring out how can I race towards not having to have this job, let me just put this seed in your mind. Imagine staying in that job an additional year. Yes, I said year. An additional year than you wanted to. But coming out of that with savings, with all your health insurance, with that major thing that happened that you weren't expecting to happen, but you were saved because of your health insurance. Imagine having a higher mental health. Imagine spending that time maybe even meeting your co-founder at an event at work and not having sold 20, 30, 50% of your company to someone who came along and saw your desperation and saw your need and took advantage. And then you go off and you just have a different master at that point, right? So try to think of different ways you can bootstrap. This is just a high-level list. We will talk about this a lot in this course. Carl Mix is a company that I really love them. I met them when they were doing less than $10,000 in revenue per month, and now they've done more than $5 million in just a few years. When I have these conversations with founders, it's really their chance to tell me the priority points for them. Are you trying to raise more? Or are you thinking, nope?
We're not trying to raise more, but we do know that with the rebrand, it might be necessary. So we're trying to work it out.
We're trying not to.
Yeah, see if we can do it without raising money, but it's not off the table.
That'd be great if y'all could do it without raising money. And then I can ask them questions that are the challenging ones. Like, let's talk about the bottom line. Let's talk about how you're doing numbers wise.
We're at a point where this year it's all about being profitable. Mm-hmm. Last year we grew from 1 million to 5.5 million. That's excellent growth, but
that's crazy.
It made us. I think it's official that we're one of the fastest growing hair care companies like ever.
Hi, it's me again. Okay, so this is for anyone who skipped the bootstrapping portion of the module. Go back and watch it. I promise you're gonna love it. If I were starting a company from scratch, I would bootstrap it for as long as humanly possible, and you're gonna find out why in the video. So check it out. Okay, let's talk about just a few terms and jargon that are used all of the time in the venture capital space and startup world, all of that, just so you can have some foundational information. A lot of you will already know a lot of this, some of it, most of it. But a lot of you may not, and that's okay. Let me just say this. I ask questions constantly. That's one of my biggest hacks ever. Yes, I know a lot because I've experienced a lot in this world, but every day I ask questions if I don't know the answers. And one of the things that, makes the most impact on me is learning and always being curious and always being open to understanding new things. So don't feel bad if you don't know one of these words. And it's kind of fun. Maybe you may see a word on here that you thought you knew, but this gives it a little bit more clarity. So we're going to run through these really quickly. Okay, a pitch deck. So a pitch deck is a PDF, or it can be a PowerPoint or another form. You can sit online streaming, present it to you on stage, et cetera, et cetera. But it's essentially a group of slides or a group of pages back to back that explain what your company is. And I say that these are table stakes for being in front of an investor or other people that you want to come in on your company. And that's because it's used so ubiquitously. Everybody uses a pitch deck, so you kind of have to have one even if you don't use it a lot, just so that if someone asks you if they're interested, you have that kind of backup. Now, you also will use different forms of your pitch deck or your deck. Usually I just call it a deck, for different situations. So you may have one deck that you use when you go and you do a pitch competition, or you present to someone at a school or some sort of summit. You might have that deck that explains what's going on. You may have another deck that is 70% the same, but has a little bit more information when you're presenting to an investor. Maybe some of the information is a little bit, some of the things you don't want them to know necessarily if they're not an investor, or it's simply too much information and you don't want to share that with everybody that looks at the deck. You may have a third one that is for potential hires and 4 or 5 others. It doesn't really matter. No one's counting, but just so you know that is what a lot of founders do, a lot of entrepreneurs do. And you can create yours. I mean, this is a deck. The thing that I'm using, that I'm sliding through, is a deck, essentially. It is a presentation, and I don't know how to make decks, really beautiful ones like a lot of people have done. You can hire someone to do it if you want. You can learn how to create it yourself or already know how to do design. I would spend the time to do so. But hey, here's a big hack. And again, many of you may already know this, but if you don't, it's going to be very helpful. It's a website, app, etc. called Canva, Canva.com. Check it out. They have all kinds of templates, let you set things up. This is how I did this. I am not very design oriented in my head here. It's all lots of stuff going on up here. And Canva is just a lifesaver. And they have a free version that's light, and then they have a paid version that I think is well worth it, especially in lieu of hiring a designer, because a designer could be very expensive. And you want to pay designers well because it's a huge talent. MVP, you may have heard of this, minimum viable product. The bare minimum you can put out into the world to prove your concept without breaking the bank or taking a ton of time. It's great for bootstrappers, and if you remember, bootstrapping is my favorite type of funding. So it's great for bootstrappers who want to experiment and to iterate and prove what they're doing, prove the concept of it, but not necessarily put in 6 months, $100,000, etc. into it. So let me give an example. Let's use this class as an example because we're in the class together. So I wanted to do this class really badly, and I just wanted to get the information out to you. So I could have said, okay, over the next 12 months, I am going to hire a film crew. I'm going to hire a big designer. I am going to make sure that I have some really nice clothes, get my hair done, have my makeup done every day, and get everything together and build out all of this process. And I'm going to think about it and talk about it and be about it and do all that for 12 months, and then I'll release it. Or I could do what I did, which is throw on my hoodie, deal with my corona hair. This is what I call the Rona hair. Get a ring light on me, figure out how to make that work, set up my podcasting mic that it took me a while to figure out how to do, but set that up, get the Canva out, get the webcam, use the webcam, write out my outline by myself, go on Canva, make slides, and let me and my content be the star of the show, and the information be the star of the show. And I got that out within weeks rather than months or years. This would be my minimum viable product. I will be able to build upon this over time. So you may be watching this in the spring of 2020 and you see 20 different videos. Great, awesome. You also may be viewing this in the spring of 2021 and there are a bunch more videos, a lot more content, extra things. Now there's maybe more production value, all sorts of things. Who knows? There's guests, who knows? Because I was able to build off of my minimum viable product, but I was able to get this out into the world. And so it can be very beneficial to you. You don't want to do anything super cheap. You don't want to come across as like, I didn't care or it wasn't good. But I felt confident in my content. And if you feel confident in what you're building and you just want to have users using the product or service, you will find a way to get a minimum viable product or an MVP out. ROI, return on investment. It kind of speaks for itself, but it's how much you will get in exchange for what you give, pretty much. A lot of times investors use this to say, okay, if I put in $10,000, what's my ROI? You can say to them, well, I can't promise you anything, but I hope that within 7 years, you'll get a 3x return, right? And there's a lot that goes into that, but that is the general term of what they're using it. Also use it when you think about what you invest. For instance, again, we'll go meta again, this class, this course, your ROI in investing in this course, hopefully is you save a ton of money, which is what I hope to provide for you, because you're able to make sound decisions after knowing what your options are. And then you use it in other ways to learn how to bootstrap, or maybe you find an investor after you watch this course. Something. And it doesn't always have to be monetary to be an ROI, to have a return. So that's a second way of thinking about it. And then you can think about it when it comes to your customers. What are your customers getting out of their investment in you, out of their investment in your product? What's their ROI? And that's a really great way of thinking about how you can break down value for your customer and realize and really see if your company is giving them value. Think about what their ROI is in investing in you as a customer. A term sheet. I know you've heard this. You may not know what it is. A term sheet, I'll read from it, is a document that an interested investor will give to you that details overall terms of a deal, what's in it for each party, etc. It's not binding. Now, you have other documents that follow it that are binding, but this is a term sheet. But there are high expectations once you receive this. It's like a gentle person's agreement, right? If someone sends you a term sheet, they are saying, this is what I'm willing to do. And if you accept the term sheet, we'll go in and we'll do all the legal documents. And you usually only get a term sheet once an investor is very interested in you. One term sheet can be used to help set terms for other investors. So you may get a term sheet from a large investor, or a large angel group, or a fund manager, and they say, okay, I want to give you $100,000 on a convertible note, which is a loan we learned earlier. And and these are the terms, and this is when it needs to be paid back if it doesn't convert to equity, blah, 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 et cetera, et cetera. You can then take that term sheet and go to a different investor, and you say, or you could take it physically, show them or talk about it vaguely, depending on how you want to negotiate. And you can say, I have a term sheet from XYZ, and this is what they're offering. Would you like to come in on those same terms? And a lot of times, especially angels, will like that because the terms are being set for them and they are just saying yes or no to it. So think about it in those terms too. You can use the term sheet to compete with another investor's term sheet. Say you have some interest out there. You have some traction, and so you have some interest. You have two major investors who are interested. You get two term sheets. You look at the terms. One of them is slightly better than the other. You can go back to the second investor and say, can you match or beat these terms, because I have both in front of me and I want to make a decision. You don't even have to choose the one that has the better terms if you like the other investor better, but you can use it as a negotiation tool. And a really important thing here is that when you do get into term sheets, when they do come your way, be honest. Don't reach out to an investor and say, I have a term sheet from blah, 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 and you only have a day to make a decision. If you don't really have a term sheet from them, you have just blown your reputation out of the water. You're no good here if you do that, because investors talk to each other. They vet each other. If you were to write to me and say, I have a term sheet from Andreessen Horowitz for $250,000 as a seed round, and they want an answer from us in 7 days, the first thing I'm going to do, even before I write you back, is I'm going to get on the phone or send an email or send a text to any number of my friends at Andreessen Horowitz and say, do you know this person? Are they telling the truth? So you never want to even exaggerate when it comes to term sheets. You want it to be the real deal. Unicorn. It's a company that's valued at $1 billion. Zebra. This is a newer term that's a little bit more founder friendly. It's a company with many stripes, not based on huge valuations, but on values. That's how I describe it. There's a bigger way to describe it, but it's basically underrepresented founders coming together and saying, I don't need my company to be worth $1 billion one day. Therefore, I don't need to go out and find venture capital. Or if I do, I want to find someone who is friendly and I'm willing to take on debt versus equity, et cetera, et cetera. All of those things, if you skipped above, check out all of those terms to know what I'm talking about. But it's just a cool term that is now being coined by a group of people. Dry powder. This is the amount of money investors have on hand or incoming to invest in new companies or follow on in current portfolio companies. You'll hear an investor say, like you might have heard me say it before because it happens all the time. They can say, I don't have any dry powder. We've made all of our investments for the year. Or I don't have dry powder until 3 months from now when we have our first capital call. And a capital call is when an investor at a fund asks their investors to pull in money, to wire funds to them so they can make investments. So that's why I said incoming, because you may have dry powder if you know that in 3 weeks there's a capital call happening. You can kind of, give or take. It's not a big deal, but I wanted to make sure you had that. B2B versus B2C, business to business. So selling your product service to another business organization, and business to consumer, selling to the general public. So B2B is Salesforce is a great example of that kind of meta-ly, in a meta way, because they sell to businesses who are selling to businesses, but they are a B2B company. And B2C is more like, hey, I'm selling like Curl Mix is a great example because, like if you saw in the case study, because Curl Mix sells hair products to an end user who is a customer, who is one individual person, and that's a B2C company. Founder market fit, the special sauce that makes the founder perfect for the company they're running. I'm a good example of this. Backstage Capital, my company. Backstage Studio, my company. Arlan Was Here, my company. All of those companies, I am probably the best fit to run those companies because of my background, because of my interests, my experience, what I bring to the table compared to what the companies are. Investors, mostly vendors, and even potential team members love when there's great founder market fit. It's a great thing to strive to have. I say strive to be, but it's to strive to have, right? SaaS, SaaS. SaaS. Software as a service. That's what it stands for. So your Slacks, your Gustos, your Salesforces, again, anything that is using software and you are not interacting with another human being on a day-to-day basis to run that software. It is automated in how it gets to you and how you're able to use it. So it's pronounced SaaS. And I used to say that I was SaaS, SaaS, as a service when I first got into venture. You're welcome. A/B testing. Experimenting with two versions of something to see if one has an advantage over the other. It's mostly used in marketing, but can be great strategy in negotiating. A great example of A/B testing is in your deck. Like, make two decks that are 90% the same, but change one slide or change the order of the slides and see which one is getting more traction, which one is bringing more people to you. Another example is, and I won't get into here because it's a whole marketing thing, but another example is, let's say you market something on Instagram and you do paid advertising. You do one version of the ad here and you spend $30 on it, and you do another version of the ad here and you spend $30 on it. Which one is getting more clicks? You've just A/B tested because you did them both at the same time. And now you know B was actually better, so I will double down on B. And so you can see how you can relate that and apply it to other ways of negotiating. UX, UI. Okay, this one has a million answers because it's harder to explain. Sometimes it's a full course at a college, so I'm not going to answer all your questions here, but I'll give you an overall view of it. And you may be a UX, UI person and think I am not explaining it the best way I can. Open to those suggestions, but this is how I think of it and how it's been presented to me. UX, user experience. That is a fact. That's what that means. This description is now my opinion. What it feels like to navigate a website, a product, or a process. Think the checkout process. So when you signed up for this class, clicking this button and taking you to this page and this and that and the other, the navigation bar order, the ease of use, that's the mechanics of it, the experience of it. UI, on the other hand, is the user interface, which means how things appear, feel, are. So think the button colors of the website, the navigation bar font, the design more so. They work hand in hand. They sometimes overlap. They sometimes are the same person that has both skills, but both are. But it is a separate thing. So, yeah, it's not the best description, but that helps me. And if it helps you to go back and listen to that again, or take the picture of the deck, or take the deck that we give you, do so. And again, I'm open to suggestions of how to better phrase it. Okay, so there are dozens and dozens of words that are used over and over and over again. So I will continue to add to this section over time. And hopefully we'll have this really robust group of words. But in the meantime, this is just a quick overview. Another thing I wanted to show you are tools of the trade, because again, I'm not going to cover them all, but I just want you to know what I use. So this is a list. I will read out the list in case you're listening through audio, but these are things that I use on a day-to-day basis. Slack for internal conversation. Twitter for, believe it or not, most of my hires came from Twitter relationships that happened over time. It's really interesting. We'll talk about that more in the branding section. Notion for interacting with your remote team. So they can be typing in something over here in another state. You type in over here. It's a really great way of keeping things organized. My team uses it a lot more than I do, but I really do like it. Canva, I mentioned that earlier. Screencast is what I'm using right now in order to record this with the deck showing. So if you've wondered how I have my little tiny face in here on screen, but you're able to see the slides, I use something called Screencast. If that helps you with your purposes, I'm happy to share it with you. I use YouTube tutorials. Remember earlier I said I ask a lot of questions. I use YouTube tutorials all the time. All the time. Use them. Love them. Audible. I use Audible to listen to consume books by audio. It's much easier for me to do so. Now I have these books behind me, and I have many, many books that you can't even see. And I like to reference those. So I'll pull those out, reference them. But if I'm listening to a book for the first time, I'm listening to it. I use voice memo to give myself notes and to give other people notes. I don't always text, and sometimes I will just send a little voice note or a voice memo to do a lot of things. I use Anchor for podcasting. If you don't have a lot of technical background or time or money and you want to put your voice out into the world, Anchor is great. We'll talk about that more in the branding reputation section. Gusto for my payroll. For 3 different companies. So what I suggest that you check out Gusto if you haven't yet. We love them. I have a bank. I don't know why I just put the word bank there, but I have a bank, a lawyer, a MacBook Pro, which is what I'm using to record this on. It's a really great investment. It has been for me. I get a new one every 3 years or so. For about a year, about 5 years ago, I used a Microsoft Chromebook. It cost about $300, and it was awesome. So I just kind of use what I need for the moment. The MacBook Pro, the newest one, has been very helpful to me. Let's see, Shure mic. So this is a Shure mic. People have been asking what kind of mics I use for my podcast. And for this is a Shure mic. I love it. It has a little mic stand. It's a bit expensive, but I don't have to upgrade anytime soon. And then I use pen and paper. I don't know. That's probably not interesting to most people, but I'll even show you. Like, I use pen and paper. I type some, yeah, but like I said in the opening video, the intro that I know you watched, I like to handwrite notes so that it can stay with me, and I think pen and paper stand the test of time. So I just wanted to share that with you. And that concludes this section of the tutorial. I am so happy that you were here, and I'll see you in the next video.